Hello and welcome back to Stein Investments. In our last video we talked about the Smart Stop Indicator, a tool we created for two reasons. First, because many of our users kept asking, where should I place my stop loss and how do I choose a level that actually makes sense? And second, because I read an interview with a fund manager who said, I only take trades that offer at least a 1:5 risk to reward ratio. Why? Because with that type of asymmetric payoff, he can afford to be wrong several times, and one good trade pays for everything. That really made me think. How can we help traders identify situations where such strong asymmetry actually exists? Looking at a normal chart won't tell you that. Price goes up and down, but you don't see the structural context behind it. And that's why we built this Smart Stop Indicator. It shows breakout bars, like this one, structural transitions, and statistically normalized stop levels, all based on ADR. But the indicator has one limitation. It works only for the symbol on your chart. And this brings us directly on today's topic, the Smart Stop Scanner, our full market stop structure engine. Let me open the panel. The scanner takes the same structural logic from the indicator and applies it across all symbols in your market watch. You instantly get the symbol, the current bid, direction of the last structural stop, the exact stop loss price, SL %ADR with adaptive color scale, distant %ADR with risk classification, the time when the stop was formed, and the status, valid, new or broken. This is essentially your complete stop loss overview for the entire market. Why is the SL %ADR so important? Each stop level is normalized by ADR and classified into very tight, tight, medium, wide or very wide. This allows you to instantly see, is this stop efficient enough for a good risk and reward? Is it too wide for a clean entry? Or is the move already overstretched? And the best part, the classification is statistical. It adapts to each symbol individually. Just to give you an example, here Australian dollar, Canadian dollar, you just move the cursor here to the numbers and you see SL %ADR 9.3%. SL range is very tight relative to previous stops. And in our latest update, we improved one of the most important elements, the distance to the stops. Previously it was shown in pips or points. But absolute numbers make no sense across different markets. 40 pips in Euro USD, 40 pips in Euro NZD, 40 pips in Bitcoin. These are completely different realities. So we now normalize distance using ADR as well with an adaptive color scale. And you'll see at a glance if your risk level is safe or in danger to be stopped out. This gives you instant clarity about how close the market is to invalidating the structure, regardless of the asset class. Let's walk through a practical example with AUD against the Japanese yen. When I first prepared the recording for this video, the latest stop in AUD Japanese yen was still at 9.6 ADR, a very tight and highly attractive structural setup. Since then the market continued to push higher and Aussie dollar yen has now formed a new stop to 16.8% ADR. No longer tight but mid-range. And you see that here in the panel as well. So the color changed from green to this yellow style. The SL range is medium relative to previous stops and so not ideal for entries, but okay if you just trail it. And this is actually perfect because it shows how the Smart Stop system behaves in real time. Earlier, volatility was low, structure was compact, the stop was extremely efficient. Now, momentum expanded, swings became larger, the new stop widened accordingly. This is exactly what we want from an adaptive stop model. Even without seeing the earlier snapshot, you instantly understand what happened. The move unfolded volatility expanded, the structural stop adjusted. This is the kind of insight a normal chart will never give you by default. And that leads to an important lesson. Static stop loss concepts don't work in a dynamic market. Smart stop scanner adapts as structure changes. What was a great entry an hour ago might no longer be ideal now. And with the scanner, you can spot that immediately. I will give you another example why this SL ADR is so important. Let's have a look at the earlier market structure of this pair, and you see there has been a stop with 7.4% ADR. It was extreme tight. You would have entered here with a stop loss here. The next stop loss was double the size with 16.2%, and it was formed with this bar, and your stop loss would have been here. This means if you risk the same amount of money on both of these opportunities, your trade would have been double the size here than here. So you can trade here with 0.1 lot and here with 0.2 lot. The risk in money is the same, but your outcome is entirely different, because if you start here with 0.2 lots at this stage, taking the trade up to this level or even higher, as you can see, because this trend still continues, it makes huge difference to your outcome than when taking a trade here with a bigger stop loss percent ADR. Why are these two columns so powerful? Because you instantly know, am I early in a move? Am I in the middle of momentum? Or maybe I'm already late, if you see a huge stop like this one, and you instantly see how far away the price is from your stop level. Let's talk about form time and status logic. The formed column shows exactly when the stop appeared. Fresh stop often signal new opportunities. Older stop might have lost their relevance, and status labels give immediate context because you instantly know if they are new, valid or broken. This eliminates guesswork entirely. Let's have a look at a broken level, Aussie dollar, Swiss franc. You see the uptrend is over. The stop loss has been broken here to the downside. There is currently no real trend appearing. There is no structure with higher highs or lower lows. So that's why there is currently no new stop level here. So you can ignore this pair until a new stop level will be formed. As in this example here, British pound against the Aussie dollar, there is a new stop level, but it's pretty big and so not very favorable, especially considering the lot size you want to trade and the outcome you want to achieve. Last but not least, one very important reminder. The Smart Stop Scanner shows opportunity, structure and risk, but it does not replace a trend analysis. Always check the directional bias, nearby levels and the volatility conditions. A stop loss can be perfect, yet the trade context can still be bad, and the scanner makes that clear. The Smart Stop series consists of 3 tools: the Smart Stop indicator with precise on-chart stop logic, the Smart Stop scanner with full multi-symbol stop analysis, and the Smart Stop manager, which automatically trails your stops so you don't have to care about your open positions. And with all 3 together, you have a complete professional stop loss system. If you want cleaner, more consistent stop loss decisions, and if you want to base your trading on objective market behavior instead of emotion, the Smart Stop Scanner is one of the most valuable tools you can add to your workflow. Thanks for watching, and I'll catch you in the next one.